We will talk about risk and return in this chapter. So we will define risk and return, and also we will define a relationship between risk and return. That's the main goal. So we will learn a couple return concepts, and then we will learn some risk concept, and then we will talk about what kind of relationship we have between return and risk. So if you look at market history, you could see that um, stocks in general does have higher return compared to the bonds. So you can see that large company stocks has a 12.1% return in the last 93 years, and if you look at the US Treasury bills, has only 3.4% return. So given the inflation is about 3%, so 3.4% is almost no return. If you even invest small stocks, you can have even higher return, 16.3%. But if you look at the risk premium, you will follow the same. You will have the same relationship between return and risk. Is that higher the return typically comes with the higher risk. So we know that in general there is a positive relationship between return and risk. To simplify things, we can assume stock returns are normally distributed. If it is normally distributed, there are some nice features of normal distribution. For example, you can predict at what percent you could expect returns to be. For example, if the average return, which is the historical return, 12.1%, if the standard deviation is 7.7%. So I'm sorry. I said it wrong. I mean, if the return is 12.1% and if the standard deviation is 19.8%, you can add one standard deviation to the mean and subtract one standard deviation from the mean. So that would give you a range of returns. In this case, plus and minus one standard deviation will give you a range of minus 7.7 to 31.9%. So that range, so 68% of the returns gonna fall in this range. So I can predict that a 68% chance that return is going to be between minus 7.7% and 31.9%. So these are kind of nice features to predict the range of the returns, but actual evidence shows that actually stock returns are not normally distributed. So what do I mean by not normally distributed? Typically the regular means are regular stock returns has a very thick tail compared to the normal distribution. That means extreme events around these tails would be more likely than it's suggested by the normal distribution. For example, observing return less than minus 47.3% is not very likely if the stocks are normally returned. I mean, this is as you can see, is 99% of the time it's going to be in this range. So that means each tail is going to be half percent. So half percent chance that return could be less than 47.3%, but actual events shows that this is more likely to see those extreme returns than is suggested by the normal distribution. So next I will talk a little bit about the market efficiency. Efficient market hypothesis is important in finance, so you should know something a little bit about the efficient market. Efficient market means prices reflect all the information. If prices reflect all the relevant information, that means prices are correct and fair for any stocks. So that's what market efficiency means. So that means price reflects all the information because it reflects it's a fair price. So in other words, you cannot use any kind of research if the market is efficient to make abnormal returns. I mean, obviously you will get positive return, and for higher risk you will get higher return. Besides those, you won't be able to get unfair return. For example, if one asset gives you, if let's take one asset, let's say asset A, the risk is 10% and let's say return is 15%. So you cannot get 20% by taking 5% risk. So if the market is efficient, you can't do that. So there are different forms: weak form efficiency, semi-strong form efficiency, and strong form efficiency. So let's talk a little bit about these forms. So weak form efficiency means stocks are market prices reflect at least all historical information. That means stock prices reflect historical or the past prices, past information. In such markets, share price changes are random, and technical analysis that searches for patterns in past return is valueless. That means you cannot use technical analysis to make an abnormal return because stock prices reflect all information. So if the market is not efficient, I mean, for example, if you can find a pattern like this in stock prices, so now from here we know that the stock price is going to go down. So if you can find a regular pattern like this, that means market is not efficient in even the weak form because it goes up and down predictably. So this means market is not efficient in the weak form. But typically this is not the case. So you cannot use. So in this case, I can use past information. That means the past patterns to find the future movement. If the market is efficient in the weak form, you won't be able to do this. So if the market is weak form efficient, that means prices are random. That means you won't see a nice pattern like this. So instead you will see some jagged movements like something like this. Always stock markets move like this, so there is no nice pattern, so you never know what's going to happen next. Semi-strong form efficiency is a little bit more stronger than weak form. In this form, the markets not only reflect the past information but also all publicly available current information. So in a semi-strong form efficiency, not only prices reflect the past information but the current publicly available information. In this kind of market, you cannot do like stock analysis or financial analysis to find the underpriced securities. If the market is efficient in the semi-strong form, there is no under or overpriced securities based on the publicly available information. Strong form efficiency is very strong. This not only this form of efficiency says that stock prices not only reflect past and publicly available information but also insider information. So insider information means the information only an insider, like a manager of a company or an employee of a company, would have some knowledge. Everybody else wouldn't know anything about that, so it's not public yet. So it could be some information in the head of some CEO, so therefore you don't know this information. So obviously using insider information is illegal, so you cannot use insider information to make money. So if CEO knows that his or her company is in trouble, then if he has some shares, he would try to unload those shares. Then that would be illegal because you are taking advantage of your knowledge. and gain um, against your other shareholders. So therefore it's illegal. But one form of using insider information is legal. It's called mosaic theory. In a mosaic theory, you don't hear the information per se, but by diligent research, you can piece together a story about a company, and then based on that, you could kind of sense that there is something going on, and then you could realize what's going on. So that's legal. So if market is efficient in the strong form, that means even insider information is reflected in the prices. So therefore, even if you use insider information, you won't be able to make abnormal returns. There are some anomalies. That means these seems to contradict with even the weak form efficiency or some other form of efficiency, but still persist. So those kind of has some other reasons. So although everyone knows, for example, in December prices goes down, and in January price goes up. So that's called January effect, for example. Um, so everyone knows that's gonna happen, but still they do it because there are other reasons driving these behaviors. So it's not per just because of the stock market. Stock market is looks other stuff. That's why these anomalies keeps repeating. Otherwise, if the market is efficient in this weak form, you won't see these anomalies. So let's start with the return. Let's define return first. What is return? So return in the very easiest sense is you buy an asset and you hold it for a year and then you sell it after 1 year. That's your 1 year return. You can calculate your 1 year return by calculating capital gain, which is P1 minus P0 here. So P0 here is the initial price, or the price you paid when you purchase a stock. P1 is the price you sell the stock, or the price when you sell the stock, and D is the dividend you receive during this 1 year investment period. So this is your capital gain, which is P1 minus P0 plus the dividend received divided by the initial investment, which is P0, gives you the return. Okay, so if I want to give you an example, let's say an investor purchased an Apple stock for $130. So P0 here is $130. 1 year ago. Today its price is 150. So after 1 year, the price is 150. Apple also just distributed this $4 dividend. Okay, what is the rate of return this investors earn on her investment of $130? So 150 minus 130. So the investors made a $20 capital gain plus $4 dividend. So investors invested $130. So the return here is $24 profit for $130 investment, and that return is 24 over 130. It's about 18.46%. 18.46%. So that's your return. So this is the easiest concept about return. So typically capital gain, in this case capital gain is $20, and dividend, which is 4, total gain is 24 divided by $130. That's the return. Typically investments could be more than 1 year. If that's the case, typically we would average those returns. So let's say you calculated the first year return like this, and you calculate the second year return like that, third year, and what do you do with those returns? So typically we would average them, So we could use arithmetic average return, which is like those returns added and divided by the number of returns, or we could use geometric average return, which adds 1 to each return. So take the first return, add 1, take the second return, add 1, and then you multiply those returns, and that product is, you take the 1 over nth power of that product minus 1. That's going to be your geometric average return. So let me give you an example of arithmetic average return and geometric average return. So an investor purchased a stock and paid $50. So let's say this is year 0, year 1, year 2, and year 3. So investors purchased the stock here and paid $50. So the stock price here initially $50. After holding the stocks for 3 years, you see we are holding this 3 years. It could be any number of years. So if this is 5 years, obviously you had to do this for five years. So and stock is sold for $7. That means the price of the stock at the end of the third year is $70. First year the price was $55, and the second year was $62. It doesn't talk anything about the dividend, so that means when we calculate return, we will just look at the return, and then we will average them. So we will figure out the return from here to here. Let's call this R1, and here to here we will call this R2, and then here to here is R3. So let's calculate R1. So we use the same formula like in the previous slide. So P1 minus P0 plus D1 over P0. So there is no dividend here, so it's gonna be P1 minus P0 over P0. I can also write this as P1 minus P0 minus 1. I kind of prefer this one because it's kind of easier. So let's calculate the first return. So P1 is 55, P0 is 50, minus 1, so that's 10% return, right? 10% return. So we will compute the same way the second return. It's going to be 62 over 55 minus 1, because in this case 62 would be P1 and 55 would be P0, sort of. Okay, so let's calculate that. 62 divided by 55, so that's 12.73%, and R3 would be 70 over 62 minus 1. Over 62, so that's also 12.9%. So now we need to average those 3 returns. So arithmetic average return would be equals, so we'll take the first return 10%, second return 1273, the third one 12.9. Since we have 3 returns, we will divide this by 3. So the average arithmetic average return is 11.88%. So that's how we calculate arithmetic average return. So it's pretty easy. It's just repeating of the same return formula for 3 times. If you have more returns, obviously if you have 4 years investment period, so we will calculate 4 returns and divide it total by 4. So that's arithmetic average return. We also have a geometric average return concept. So first of all, calculating return is going to be the same as before, but here we're going to multiply returns rather than adding and dividing by number of years. So an investor's purchased a stock and paid $50. So I think it's a very similar question. So this is 0, 1, 2, and 3. And also we add here $1.5 dividend, so we will get $1.5 dividend here, $1.5 dividend here, and $1.5 dividend here. Calculate geometric average return. So we will calculate, so essentially geometric average return will take first return plus 1, second return plus 1 times the third return plus 1. So we'll take all this product and take the 1/3 power of that, and we will subtract 1. So I'll compute this first. So I can compute R1, which is, as you know, 55 minus 50 plus 1.5 over 50. So that's how we compute the return, right? So that's R1. I need 1 plus R1. So I will write this as 55 plus 1.5 over 50 minus 1. Since I need 1 plus R1 in the formula, you see that's what I need. So I'm going to throw this to the other side. And what I have here is only 60, so 56.5 over 50. So because 55 plus 1.5, 56 and a half divided by 50. So that's going to be 1 plus R1. So let's calculate 1 plus R2. 1 plus R2 is going to be the lost price, which is 62 in this case, plus 1.5 divided by 55. Now for the second year, the lost price is 62, first price is 55, and also we have this dividend at the end of the second year. So this is gonna be 63.5 over 55. Finally, 1 plus R3 would be 71.5 over 62. So I did a little bit more directly here. So I added the $1.5 dividend plus $70, 71.5 divided by the initial price, 62. So let's multiply these three numbers with each other and then go from there and take the 1/3 power. So this is the R1 plus R1, 63.5 over 55 is 1 plus R2, and 71.5 over 62 is the last return. I will take the 1/3 power of that minus 1. So let me do this operation. So I did this operation and I found the answer to be 14.57%. 59% actually. Alright, that's the geometric average return. Um, you might say, why do we need two different averaging? I mean, sometimes this could be better fit for your to whatever you want to do, and sometimes this would serve better. To be honest, I like geometric average return because I think it's more realistic, I would say. So I hope that gives you some idea how you calculate these different kind of averages. So next concept I want to talk about is return under uncertainty. So we calculated the average returns, right? And we calculated return under certainty. But sometimes when you want to calculate, or sometimes you want to estimate your return, you know how much money you invest, but you don't know what's going to be the future value of that investment. But you might have some idea about different scenarios and their probabilities. In that case, you could calculate your expected return. So let's say that is 30% chance this economy is gonna be very good and the price is gonna be 180, and that is a most likely scenario, which is normal scenario. The price is gonna be 150, and if the things goes bad, the price is gonna be 110. So here again we pay for $130 to purchase this stock. So in that case, we need to calculate return for each scenario and then go from there. So if the optimistic scenario happens, the return is going to be same formula. We use the same formula, P1 over P0 plus D1 over P0. So in this case, 180 is the price. Initial price is 130 plus the $6 divided by 130. So that's my optimistic scenario. If this scenario happens, I will gain $50 capital gain plus $6 dividend. So the total gain is going to be $56 over 130. So your return will be about 43%. Most likely scenario, same way. So 150 minus 130. In this case, dividend is only $4 divided by 130. So in that case, I would make $24. Remember, we did this earlier. 18.46%. So in the pessimistic scenario, the price is only 110 minus 130, and there is no dividend. In this case, my return gonna be we will have $20 loss divided by 130. So my return is gonna be minus 15.38%. So in the second step, we're gonna combine those three returns. So we will call this expected return. So we will take each return and multiply by the probabilities. So optimistic scenario is there's a 30% chance optimistic scenario happens. If that happens, the return is 43%. Most likely scenario likely to be 50%. If that happens, return is 18.46. Finally, pessimistic scenario, 20% chance. If that happens, return is minus 15.38. So if I finish this operation, what would I get? In this case, return will be 19.0705. So that's expected return, and it's called return under uncertainty because we are uncertain what's going to be next year's price, what's going to be the next year's dividend. We are uncertain about those things because of uncertainty. We call this return under uncertainty, and it's called expected return rather than average return. You see, if you do the same thing, okay, when we calculate arithmetic return, we took those three returns divided by 3. Essentially, it's very similar to the uncertainty, but essentially when you divide this thing by 3, you are multiplying each return by 33.33%. So if you take this first return, multiply by 33%, second return 33%, plus the third return 33%, you get 1188. So you give equal weights to each return when you are averaging them. So this is almost like an averaging, except that you use different weights instead of using 33% in each case. So it's the same concepts, very similar concepts, except the only last step is different. Instead of adding and dividing by 3, you're given different weights. Okay, that's a return under uncertainty. Okay, maybe we will do another example. So let's do this example. Current stock price is $6. Can you calculate the expected return? Expected return. So we will follow the same steps. So we will calculate return for the booming economy, right? So that would be $80 minus $60 plus $2 dividend divided by $60. So $22 is my gain over 60. 22 over 60. So that's about 36% return. And in a normal economy, return gonna be 70 minus 60 plus 1 over 60. So it's gonna be 11 over 60. So that's a return of 18.33%. And finally, return for recession, 50 minus 60 plus 0 over 60, so minus 10 over 60. So that's minus 16%. And final step, we will combine those. Expected return would be 20% chance it's gonna be booming economy. In booming economy, return is 36.67. That is 40% chance. It's a normal economy. In that case, return is 18.33, and that is a 40% chance it's gonna be recession. In that case, return is minus 67. And this turned out to be a nice number, 8%. So expected return is 8%. We also need to define return for portfolio. If you have a portfolio, how do you calculate your return? So you could have a portfolio of these four assets: T-bill, T-notes, growth stocks, income stocks. Their expected returns are given here, and the amount of how much money you put in each of these. So let's say you have $100,000 to invest. You put $10,000 in T-bill, 20,000 T-notes, 40,000 in growth stocks, and 30,000 in income stocks. So total investment is $100,000. It's just a weighted average. I mean, it's a pretty simple concept. So you just find a weighted average. So yeah, we have $100,000 to invest. So we just find a weight. So the portfolio return would be weight of the first asset, which is 10,000 over 100,000. That's total investment. I have $100,000 to invest. I will put 10,000 in T-bills. In other words, I'm putting 10% in T-bills, which has a 3% return. And I will put $20,000 in T-notes. In other words, about 20%. That's times 4. So now you got the idea. 40% invested in growth stocks. That has 9% return, and the following income stock we put 30%, 30,000 over 100,000, and the return is 7%. So let me rewrite this again. So I will put 10% weight in T-bills, 20% weight in T-notes, 40% weight in growth stocks, and 30% weight in income stocks. So that's 0.3 plus 0.8 plus 3.6 plus 2.1. So that's going to be 5.7, 5.7, 6.5, 6.8. 6.8% is my portfolio return. 6.8% is the portfolio return. So it's very simple. It's just the weighted average return. So let me give you another example. This time I have $300,000 to be invested. So this time I will just be a little bit lazy and then I'm gonna calculate the so 30,000 over 300,000. So 10% invested in T-bills, which has a 3% return. So 90,000 over 300,000. So 90. So it's at 30%, right? 30% invested in T-notes, which has 5% return. Income stocks, some sort of growth stocks, 130,000 over 300,000. So 130, I don't know what's that number. I'll just write that. So 15. 50,000 over 300,000. Sorry, yeah, that's the income stocks. So that's 0.3 plus 1.5. Let me calculate the other guy. So 113 over 30. So about 43% times 15. So that's 6.5. 5 over 30 times 10%. So 167. So if you sum up these numbers, so that's going to be 967 plus 0.3, 997. So that's my portfolio return, just the weighted average. So it should be pretty straightforward. So we covered that as well. Now let's talk a little about risk. So we define all sort of possible return concepts already. So next we will define some risk concepts. So what is risk? What do we understand from risk in investments or in finance? So I think the easiest way to imagine the risk is looking at this asset A and B in this slide. Asset A has an average return of 10%. 5 plus 10 plus 15, that's 30% divided by 3, that's 10% average return. Asset B also have average return of 10% because it's always 10. So although they have the same average return, we will call asset A is more risky because it varies around 10%. So yes, it is 10% average, but it could be as low as 5% or it could be as high as 15%. So because of that variation, we will call asset A is riskier compared to asset B. Asset B, it's very predictable. It's like Arizona weather, always sunny and hot, right? But asset A is like a Pittsburgh weather. There is always risk that you go with your t-shirt and then weather gets cold and then you get cold. So because of that, it's riskier. So more variation means more risk. So obviously in this case, very easy to spot which one is riskier, but you need to quantify that. You cannot just look at assets and tell which one is riskier. So we have a statistics called standard deviation or variance. So we calculate that to measure the risk. There is a population standard deviation or sample standard deviation. Difference is just the denominator. And also we have the standard deviation under uncertainty. So similar to the return concepts. So in one case you divide the variations with n, in the other that means you are giving equal weight to each of these variations, but here you give different weights. So let's do some examples. So what's the standard deviation? So can I calculate standard deviation of this? Is it different? -5. They are different. Is that the next one? Yeah, that's the next one. So how do you calculate standard deviation of this? So 3 returns. So let's calculate standard deviation of A. So to calculate standard deviation of A, first we need to calculate the average return of A. It's going to be simple arithmetic average. So 5% plus 10% plus 15% divided by 3. So that's 15, 15, 30 divided by 3, 10%. So 10% is the average return. Standard deviation, let's calculate first the variance. So we will take the first return, 5%, subtract the mean, and we will square that, plus second return minus the mean return, square, plus third return minus 10% squared. So we will divide normally this by 3 if it is a population. If it is sample, you divide by 2, right? So the first number is 5% squared. That's going to be 0.0025 plus 0. Second one going to be 0.0025. So divided by. So let's calculate sample standard deviation. So that's going to be 0.0025. That's called variance, and the standard deviation would be square root of this. And that would be obviously 5%. So standard deviation for this one is 5% sample standard deviation. So it's very simple. You can use your calculators to get the same number. So maybe I will give you let's also give you an example of uncertainty. Okay, maybe I will do one more and then do uncertainty. Oops. So if I'm calculating again, I said A, how do I calculate standard deviation? Always we figure out first the average return, minus 5 plus 10 plus 25 divided by 3. So that's same 10%. Standard deviation minus 5% minus 10% squared. 10% minus 10% squared. 25% minus 10% squared divided by 2. 3 minus 1. So 15% squared, so it's gonna be 0.0225 plus 0 plus, that's also 15% squared, 225 divided by 2, 0.0225, and standard deviation would be square root of that number. That would be 15%. So standard deviation is 15%. So how would this change if we have uncertainty case? It wouldn't change much, except you use different weights instead of equal weights. That's all. So let's do one example. So first I will start with the expected return. I hope you still remember expected return. So we will take the probabilities, multiply with the return. $18.46. 20% chance minus 15.38. Let me find this number first. So expected return is 19.078%. And the standard deviation is similar. So we'll take each return. So before I do that, so we'll take the probability times the return, 43.08, minus the average return, 19.078 squared. Second probability, 0.5. Return is 18.46 minus 19.078 squared. And the last one, 0.2 minus 15.38 minus 19.078 squared. It's gonna take. So if you do that, we get 4.1%. This is called variance, right? If you take the square root of that, you get 20.26%. That's the standard deviation under uncertainty. Now we need to talk a little bit about portfolio risk. assume an investor has to invest $10,000, and let's say we put 40% of this money in asset A and 60% in asset B. What is the expected return and standard deviation of this portfolio? So yeah, so if you put 40% of our money in asset A and 60% in asset B, what is the standard deviation of this portfolio? Uh, if you know the returns like this, you don't need to know anything else to calculate the portfolio risk. So what we do is just calculate the portfolio return for each year and then go from there. So what I can do here is I can calculate portfolio return in 2020. So let's say portfolio return in 2020. So in 2020, return on A is minus 5%, and I put 40% weight. Return on asset B is 20%, and I put 60% weight on that. So 5 times 4, that's minus 2, 12, so it's 10%. So my portfolio return, if I invest 40% in A and 60% in B, my portfolio return is going to be 10%. So portfolio return in 2021 is how much? So for A, stock return is 10%. I put 40% weight. For B, also 10%. I put 60%. Obviously, I don't need to calculate that, so it's 10%. And 2022, I put 40% in stock A, which has 25% return, and 6% is asset B's return. Unfortunately, I put 60%, so that's 10% plus 36, so 13.6%. So these are my portfolio returns for the 3 years. So now, since I have the portfolio returns, I can calculate the average portfolio return using those three numbers: 10 plus 10 plus 13.6 divided by 3. 36 divided by 12. So 11.2%. And I can calculate standard deviation like I did before. I could just say portfolio standard deviation in this case would be, I will calculate first the I will just say 10% minus 1112 squared, 10% minus 11.2 squared, 13.6% minus 11.2 squared divided by, again, if this is a sample, I'll just divide by 2. So that number is 0.000432, and the portfolio standard deviation 2.078%. So if you know the returns like this, is very simple, but if you don't know, then we are in trouble. So if you don't know, this is the formula you're gonna use, a little bit more uglier. So if I ask you a question of how you calculate the standard deviation of a portfolio of two assets, this is the formula you would use. In this formula, W is the weight. In our previous example, we used 40% for A. Sigma 1 is going to be the standard deviation of the first assets. It will multiply those two numbers and square it. Similarly, W2 is the weight in the second asset, and this second asset's standard deviation. Again, you multiply these two numbers and square. Plus 2 times W1 sigma 1, W2 sigma 2, and the rho here is the correlation coefficient. So correlation coefficient between the two is the last term, rho. As you know, the correlation coefficient could be between -1 and +1. It shows how close the two assets are following each other. So if they are perfectly in step with each other, the correlation coefficient would be close to +1. But if they are totally opposite to each other, it's just going to be -1. If they are not related at all, it's going to be 0. So, and you can have any number other than these in this range. So let's do an example. How are we doing on time wise? Oh, close to 1 hour. Try not to pass 1 hour. So we need to calculate portfolio standard deviation. So portfolio standard deviation formula is W1 sigma 1 squared W2 sigma 2 squared plus 2. Just copy the first two terms. W1 sigma 1 W2 sigma 2 without squaring them, and don't forget the correlation between the two. So that's the formula. Let's plug all the numbers here. So the first weight is 40%, standard deviation is 12. Boy, that's an ugly number. Squared. Second number 60%, and the number 0.58878 squared. I'll copy those two numbers too. 2 times 0.4 times 0.1247 times 0.6 times 0.05888, and the correlation. Okay, the correlation is not given in this question, the covariance is given. So the covariance between two assets, let's say 1 and 2, equals standard deviation of the first asset times standard deviation of the second asset times the correlation between two. That's the covariance. So essentially, correlation is the standardized form of covariance. In other words, you can take covariance and divide by the product of the two standard deviation. That's how you get correlation. So essentially, I have sigma 1 times sigma 2 times the rho. So I'm gonna remove everything else. So I need only weights, 2 times first weight and the second weight, and also I have the correlation, gonna take care of the rest, right? So what is that number? Let me pause this for a while. So I found this number to be 0.0000377,805, and the square root of that would be our standard deviation. And that number is 37%. Let me do a little bit more traditional problem. So similar problem. So what is the standard deviation of a portfolio if the investor puts 65%? So let's call this weight 1. That's weight A. Okay, 65%, and remaining 35% goes to stock B. Standard deviation of A is 28.5%. Standard deviation of B is 11.8%, and the correlation between A and B is 0.4. Use the same formula, W1 sigma 1 squared, etc. So the portfolio standard deviation is going to be 65 times 0.285 squared plus 0.35 times 11.8 squared plus the last term 2 times, I'll copy those 4 numbers, 0.65 times 0.285 times 0.35 times 11.8 times the correlation, which is 0.4. So let's compute this number, and that number is 0.042, and the standard deviation, which is the square root of that, is 20.53%. So that's the portfolio standard deviation. So I will stop here, and then I will do another video because I don't want this to be too long. See you next time.